Hi, my name is Indy. In this video, I'm gonna obtain the financial statements of Apple for the fiscal year end 2023, and I'm gonna dissect them for the purpose of making an investment decision. So I'm gonna kind of explain to you guys how to locate the statements or the annual report, what the annual report is exactly, to kind of go do my own analysis of the company, how I would do it, correct? I'll be pulling formulas and stuff from the cheat sheet that's provided, right? And then obviously I'll be using the knowledge that's obtained in my entire course to kind of work up to this analysis so you can make an informed decision. Just do keep this in mind that my analysis of Apple should not be taken by itself. It should be taken in conjunction with the market data, such as market news that's out, the actual share price fluctuation, and all that stuff. Just keep that in mind. I'm just doing a small but important portion of investing, which is the financial statement analysis, which not a lot of people understand. So in my course, I kind of broke that down in a much easier way and getting straight to the point, which are the financial statements, and then essentially the horizontal, vertical, and the ratio analysis. So just jumping onto Google, google.ca, google.com, you can kind of just type in Apple's 2023 annual report. So upon the Google research, I see Apple's investors comes up first. I see a bunch of other things. I'm just going to go into investors relations. So news and results, just kind of scrolling down. Financial data. Okay, over here, perfect. Annual report on Form 10K. So some companies are reported on the Form 10K, which is the annual report of specific companies. So essentially, if you're a public corporation and you trade on the stock exchange, by law, you have to issue annual report every year. And within the annual report, it doesn't only just include your financial statements, it includes other information as well, such as like what the business entitles, any risk factors, cybersecurity, management discussion and analysis of financial condition and results of operations. And obviously it also includes the financial statements, which is the main focus of my course. So the annual report is obviously very important because not only does it talk about what happened in the past, it also kind of tells us what we can kind of expect in the future. So I'm going to go straight over to financial statements and supplementary data, which can be found in the table of contents. If I scroll down a little bit, financial statements, and over here, as you can see, we have a bunch of different ones. So I'm just going to click on the first one. So this over here is a consolidated statement of operations. So this over here, as we could kind of just look at the accounts, this is going to comprise of the income statement, because remember, the income statement is revenues minus expenses. So over here, we have net sales revenues less total cost of sales. Another word for cost of sales is cost of goods sold. It means the same thing. So essentially, total net sales less total cost of sales gives us gross margin. And then gross margin less operating expenses gives us operating income, and then operating income plus minus any other income or expense items that we have. Provision for income taxes gives us net income, and then we also have earnings per share. Then if you scroll down, we have the consolidated statements of comprehensive income. So this is essentially going to look into, so we're going to take net income and we're going to talk about other things where we could potentially earn income or lose value. So in that case, we have things such as change in foreign currency translation. So for instance, Apple operates in various countries. So the foreign currency fluctuation can either impact Apple negatively or positively. As you can see, in this case, since this is negative, it's impacting them in a bad way. Then we also have the change in fair values, any unrealized gains or losses, which is included in comprehensive income. And then we have the balance sheet, consolidated balance sheets. So we have assets, we have liabilities, we have shareholders' equity. And as you can see, the assets are broken down into current assets. Then we have non-current assets. We have marketable securities, which we learned this to be another word for long-term investments. We have property, plant, and equipment. We have other non-current assets, which could be intangible assets and goodwill. And then we have current liabilities, which are liabilities that are due in less than 1 year. Remember, a liability is a future obligation. Then we have non-current liabilities, which is long-term debt, or any debt that we have that's more than 1 year. Then we have shareholders' equity. So looking at shareholders' equity, as you can see, we have common stock, accumulated deficit. So what that means is that this Apple right now doesn't have a positive retained earnings. They actually have a deficit. So that right automatically is a red flag, right? But however, just kind of looking at the 2 years. So remember, a company has to do their financial statements in something called a fiscal year. So in most cases, a fiscal year could be a calendar year. However, it doesn't have to be a calendar year. So Apple decides that their fiscal year starts and ends on September 30th in 2023 and September 24th in 2022. So essentially the fiscal year end is from September to September of each year. So as you can see, just kind of looking at the shareholders' equity portion, the accumulated deficit. So we had a deficit in 2022 of nearly 3,000. And just keep in mind, this isn't 3,000. All these numbers are listed in millions. So in millions, except number of shares, which are reflected in thousands and par value. So for now, we'll just say 3 million. However, this decreased to 214, which is obviously a good sign because the deficit decreased considerably. But now, why are we at a deficit, right? So we're going to look into that right now, actually. Let's do that right now. So whenever it comes to financial statement analysis, there's no set way to kind of do this. It's kind of like a puzzle. You kind of got to start off with whatever catches your attention first and kind of builds from there. So just by looking at this over here, Apple does operate in a net income figure. Like they have net income of 96, 99, 94, which is obviously very impressive. So 96,000, 99,000, 94,000. But then where is your deficit coming from? So let's have a look at this. So this is the consolidated statements of shareholders' equity now. So shareholders' equity, remember, shareholders' equity is comprised of common stock. And so this is equivalent to the statement of changes in equity in my course. So remember, we have common stock, then we have retained earnings, and then we have accumulated other comprehensive income, OCI. But just looking at the retained earnings portion. Okay, perfect, right over here. So remember I said how the deficit is a red flag, correct? Because remember, deficit is equivalent to retained earnings, and the formula for the retained earnings is the beginning balance plus net income minus dividends is the ending balance. So what Apple is doing instead is within retained earnings, they're actually inputting common shares repurchased. So that's kind of strange to me because this should be part of the common stock over here. Like anything that we repurchase should actually reduce this balance, but they're taking this out of retained earnings directly, which is fine because every company does things a little bit differently. So you kind of have to kind of go in and figure out what they're doing and why they're doing it. So even though Apple does have a net income, which is fairly high, their deficit is coming in the form of obviously the Apple's also paying cash dividends, which is a good thing. So you being an investor, there's two ways you want to earn money, either through dividends or capital gains. Dividends being like the company pays a yearly dividends. Capital gains meaning that the value of your shares has increased. So the fact that Apple's paying out a dividends is very important. So let's actually go ahead and calculate the dividend payout ratio. So the dividend payout ratio. So the formula for the dividend payout ratio is going to be dividends declared divided by the net income. So this pretty much tells us that how much of net income is Apple actually paying out in dividends. So we'll calculate for 2023, 2022, and 2021. So essentially what we're going to do is For 2023, we're going to simply take the 14,996. So remember, whenever we have brackets, that's considered to be a negative number. So all that means is that that's reducing our retained earnings balance. So we're going to take 14,996 divided by 96,995. That's 15.46%. And then for 2022, we're going to take the 14,793 divided by the 99,803, which is 14.82%. And then for 2021, we're going to take the 14,431 divided by 94,680, which is 15.24%. So as you can see, the dividend payout ratio is very consistent from year to year. From 2021 to 2022, it actually decreased, and 2022 to 2023 actually increased, but it's fairly consistent, right? And the thing is, so to kind of figure out if this dividend payout ratio is a good thing or a bad thing, it all depends on like the type of investor that you are. If you're banking on, let's say, for example, for Apple to keep increasing their share price over time. So remember, essentially net income, either they could pay it out in dividends or they could retain it back into the company to reinvest into the company to buy like more long-term assets, etc., to grow the company in the future. So if you're reinvesting the money within the company, what that means is now that the share price could potentially increase a lot or can increase in the future. However, that's only if Apple makes the right growth decisions, which is obviously, you can kind of pick that up in the market news, correct? Let's just say, hypothetically, that Apple decides to reinvest their net income into a project that actually isn't good for the company. So the share price might actually drop as a result of actually increasing, correct? So now let's just say that, okay, we want to know if within Apple's industry, if this dividend payout ratio is actually sufficient. So what we're going to do is I'm going to go into Google now. Before I even look at Apple's industry, let's just say I'm confused of what industry Apple's actually in. So I'm just going to quickly search up Apple's industry. And let's see what comes up. So Apple's industry, what is the industry for Apple? So Apple is within the consumer's electronic software services, online services. So I'm just going to copy and paste this over here. Copy this over here, paste it over here, and I'm going to type out industry payout ratio. So I'm going to see what the actual payout ratio is for the consumer electronics industry, just to get a kind of a rough number. So the payout ratio for the industry in the fourth quarter is 23.78%. Remember, this is just a rough number. So at least now we have a rough number to compare it to. So 23.78%. So if you're looking for a dividend stock in comparison to a capital gain stock, Apple might not be the best investment for you, because Apple pays out a dividend ratio or a dividend payout ratio of 15.24%, whereas the industry average is about 23.78%. So they're below the industry average. However, if you're looking for capital gains, then Apple might be the better option for you. So let's go back into the financial statements and dissect more information now. So we're also given the consolidated statements of cash flows. So in the consolidated statements of cash flows, we have operating activities, we have investing activities, and we have financing activities. So remember, operating activities has to deal with the day-to-day business transactions. And as you can see, Apple is generating sufficient cash flows from its operating activities. So from 2021 to 2022, their operations actually increased. Remember, the statement of cash flows deals with cash coming in and cash going out. So cash inflow, cash outflow. Obviously, you want more cash coming in than cash going out in terms of operating activities. So this actually increased and decreased. So let's have a look at, so that's not necessarily a bad thing, to be honest, because even though it did decrease, it didn't decrease by a lot. We're still we still have a significant amount. So let's just say now you want to perform the horizontal analysis on the cash generated by operating activities, right? Horizontal analysis, and you just want to calculate the percentage change, correct? Just to see how much it actually increased by and decreased by. So you want to calculate the percentage change. So remember, the horizontal percentage change, the formula is going to be the new value minus the old value divided by the old value. Or in other words, if you look at the cheat sheet, the horizontal percentage change for a period will be the analysis period amount minus the prior period amount, which is equivalent to the new value minus the old value divided by the prior period amount. Okay, so we're going to do it from 2022 to 2021. So in this case, I'm simply going to take the new value, which is the 122, 151, minus the 104, 038, divided by 104, 038, which is 17.41%. So what this means is that from 2021 to 2022, it increased by 17.41%. Now 2023. So the new value is going to be the 2023 value. So 110,543 minus 122,151 divided by 122,151. And then just to kind of put it into a formula. Okay, so yeah, from 2021 to 2022, we had an increase in cash generated by operating activities by 70.41%. However, in 2023, we had a decrease of 9.5%. So that's actually a red flag for me now. So re-looking at this, that's actually a very significant amount in my opinion. So why did this decrease? As you can see, net income also decreased as well. Correct? So we'll actually focus on net income in a bit. Let's just keep focusing on the statement of cash flows for now. So then we're going to look in over to investing activities, and you generally want this to be a negative number because remember, investing activities is the company investing into the future growth of the business, correct? So essentially the purchase of marketable securities, that had actually decreased a lot. So you want to kind of go in now, figure out using the market data, why did that decrease? Why is Apple now purchasing less marketable securities, right? They've even sold marketable securities as well. So as you can see, a bulk of Apple's investing activities has to do with marketable securities. So this is like Apple investing in equity financing, sorry, not equity financing, but equity investments and debt investments. So Apple's either is lending companies money, or they could be investing in the shares of other companies. So that's what that means. Apple's acquisition of property, plant, and equipment has been very consistent throughout the years, correct? And then even other, we kind of ignore that. So this is another red flag because Apple is now investing less in marketable securities. So you kind of want to go in and figure out why that is, correct? But now looking at the financing activities, Apple is doing a pretty excellent job of taking their profits, correct? Or their operating income, not necessarily the profits, because profits is net income. So Apple's doing a pretty good job of taking their operating cash flows and utilizing it to actually go out and repurchase common shares. So Apple is now decreasing their equity financing, which is a positive sign because that means Apple has enough cash flows to kind of go out and repurchase common shares to reduce the ownership percentage outstanding. So to me, that's an excellent sign, right? Because Apple is in a good position right now to actually do that, correct? So that's kind of studying the statement of cash flows. And now we have the notes of the financial statement. So I'll kind of show you how to use these, but like the notes just kind of dive into each account in more detail. That's it. So let's actually start focusing on a few ratios now. So the first ratios that I want to kind of focus in on is going to be the profitability ratios. So I'm going to kind of just focus in on the gross margin first. All right, perfect. So I'm going to calculate the gross margin for 2021, 2022, 2023. So gross margin is going to be equal to the gross margin divided by net sales. So this is, remember, gross margin percentage, you could say. All right, so for 2021, gross margin, it is 152,836. And remember, gross margin is a product of total net sales. 365,817 subtracted by total cost of sales, which is 212,981. So I'm going to take the 152,836 divided by net sales, 365,817 to arrive at 41.8%. I'm also going to do it for now for 2022, 170,782 divided by 394, 328. Then I'm going to do it for 2023 as well, 169, 148 divided by 383, 285, which is 44.1%. So as you can see, the gross margin has actually been increasing, which is a great sign. That's an excellent sign. So remember, gross margin is essentially how much direct profit we have to cover our operating expenses. Because remember, cost of sales is the direct expense of purchasing that inventory or performing that service. Because remember, if Apple sells an iPhone, it obviously costs the money to make that product. So the direct cost of making that product is the cost of sales. So what they're saying is either Apple has been successfully increasing their selling prices, correct, per unit, or they've been saving money on the raw materials that go into their products. Right? So this is an excellent sign. So what this means for 2023 is for every dollar in net sales, the company has 44 cents in gross profit. Then the next one that I'm going to calculate is going to be the net profit margin. And the formula for this one is simply going to be the net income divided by net sales. So once again, I'm going to do this for 2021, 2022, 2023. So in 2021, net income was 94,680 divided by net sales of 365,817. It is 25.9%. In 2022, I'm going to do 99,803 divided by 394,328. 25.3%, and 2023, 96,995 divided by 383,285, it's just 25.3%. As you can see, Apple's net profit margin has been very consistent every single year, which is very good. And you could also see that from 2022 to 2023, total net sales actually increased after they actually decreased after increasing from 2022 to 2021. And that's also evident in, remember the percentage change that we calculated for operating activities? So something is clearly going on within the operations of Apple. So something must have happened between 2022 and 2023, which has resulted in these results, which can be found in the market analysis of the company. So financially, we have a decrease here, and that decrease also resulted in a decrease in the net income figure. Even though net income decreased, the overall net profit margin is still very similar, which is excellent. So I'm going to actually go out and I'm going to actually look for the industry net profit margin ratio and see on average what the industry earns. So just by scrolling down a little bit, I came across this over here. So over here, we have different industries, and the same for information technology services, which just kind of fits in Apple's industry. Because remember, Apple does software services as well. So information technology services is very similar. So their gross profit margin is 37.8%, like the industry as a whole. And Apple's is much higher than that. And then the average net profit margin is actually negative 0.6, whereas for Apple is 25.3. Once again, Apple is doing very good in comparison to the industry. Now let's have a look at this link over here. What is a good profit margin for electronics? So consumer electronics is what Apple sells as well, because remember they sell like MacBooks, iPhones. So for the consumer electronics industry, it's about 27.35%. Once again, Apple is doing excellent. And the net profit margin is 6.32%. Once again, Apple is doing excellent. So in terms of the profitability, Apple is doing very well. Another metric we can look at is earnings per share. To calculate earnings per share, we could easily take, so the earnings per share calculation, the formula is going to be net income subtracted by essentially the weighted average shares outstanding, correct? So the earnings per share actually has another attribute to it. So we have net income minus the preferred dividends divided by the weighted average shares outstanding. So we want to see now if the company had issued any preferred dividends. So by just looking over at the balance sheet real quickly, under shareholders' equity, the company doesn't have any preferred shares outstanding. It just has common stock or common shares outstanding. So we could do a quick search as well. So I'm going to go quickly search the document and see if there's any preferred stock outstanding. So I see preferred stock over here. It says if any, correct? So these are the only items that show up for preferred stock. And this doesn't really give us an indication that the company issued preferred stock. So we kind of just confirmed that. So essentially this part of the formula, we can ignore. So it's just gonna be net income subtracted by the weighted average shares outstanding. Now let's go back to the financial statements, quickly go locate them. So these are the different notes. We're going to get past the notes. Keep scrolling up. Here we go. And another indication that we can kind of do now for profitability is going to be the return on assets. Because I want to see how well the company utilizes its assets in order to earn profit. So the return on assets has a formula, which is going to be net income divided by average assets. So the thing is, if you have a look at the consolidated balance sheet, we're only been given to us it for 2 years. So to calculate the average assets, I'm going to ignore that part completely just for the purpose of this analysis. Because remember, the average is going to be the beginning plus the ending divided by 2. But since we're not giving them the 2021's information, I can't calculate the return on assets for 2 years. So instead, to calculate return on assets for 2023 and 2022, I'm going to do net income divided by assets. That's it. So in 2023, the net income is 96,995 divided by assets, which is going to be 352,583, so 27.5%. Then in 2022, net income is 99,803 divided by assets, which are 352,755, so it is 28.3%, or you could say 0.29%. So overall, the return on assets is fairly similar from both years. So what we're saying is that Apple, for every dollar invested in its assets, remember assets are future benefits, Apple in 2023 earns about 27 cents in net income, correct? So that's a pretty good number, right? So you could say that Apple has consistently been utilizing its assets to earn net income, which is a positive sign, correct? Now I'm going to go in and kind of do the liquidity ratios to see how liquid the company is, the liquidity ratios. So The first one I'm going to do is going to be the current ratio, which is essentially going to be current assets divided by current liabilities. And once again, I'm only going to do it for 2023 and 2022 because that's the only data that we're given on the balance sheet. So for 2023, current assets is 143,566 divided by current liabilities 145,308, which is 0.98. That's actually very concerning. Very concerning. So 0.99. Then in 2022, current assets is 135,405 divided by 153,982. It is 0.88. So the overall liquidity position of Apple is very questionable because the current ratio, so remember, the current ratio essentially tells us how much current liabilities are due and how much current assets the company has to pay off those short-term obligations. Right now, Apple does not have enough current assets to cover its current liabilities as they come due. However, that position did increase from 2022 to 2023 because remember, the higher the ratio is, the better. But this is still a significant red flag for me though. However, this red flag can kind of be, what can I say? Kind of be diverted because looking at their marketable securities. So even though the current assets or the current ratio is below 1, because what this says is that for every dollar in current liabilities in 2023, Apple has 99 cents of current assets. On average, you want a ratio of at least 1.5. So you have $1.50 of current assets to cover your current liabilities as they come due. But I'm looking at marketable security because remember, looking at the statement of cash flows, we figured out that Apple has a lot of marketable securities, correct? You know what? Let's actually go in and see if we can find more information on this. So marketable securities, I'm just gonna do a quick search find. Quick search find. Right over here. So as you can see, note number 4 has cash, cash equivalent, and marketable securities. And so they have different levels of marketable securities. They have level 1, level 2. And just by looking at this, some of these are money market funds, and some of them are mutual funds and equity securities. So money market funds simply means those investments that Apple could pull at any time and get their cash back, correct? And then they have a bunch of different ones such as level 2, which includes like treasury securities, commercial paper, which are fairly safe as well. And let's just say, for example, that you don't know what commercial paper is, right? So I'm just gonna quickly copy this. I'm gonna jump onto Google. I'm gonna type in commercial paper, then I'm gonna type in a website called Investopedia. This is a great website to kind of look into any terms or definitions that you don't understand in accounting or finance. It's a great website. I learned half my accounting off this website, to be honest. So there's key takeaways. So commercial paper is a form of unsecured short-term debt. Short-term debt meaning less than 3 months, essentially, right? So they can range from anywhere from 1 to 270 days, but they average around 30 days, correct? But usually short-term is less than 3 months, right? When it comes to short-term debt. But like there's different ways how different companies kind of interpret it, correct? But like at least now we have a general understanding about what commercial paper is. Then I'm gonna just keep going through this and see if there's anything else more about marketable securities that's important that we could use. So it says that the company is exposed to credit risk and fluctuations in the value of its investment portfolio because obviously they have a lot of marketable securities. That risk is always going to be there, correct? But yeah, just to kind of go back to marketable securities. So they have marketable securities in the current assets and long-term assets as well. So my point regarding marketable securities is, even though their current ratio is significantly less, marketable securities are like investments in other companies potentially that Apple could sell right now and get their money back. Let's just say hypothetically that Apple had a lot of their money invested into property, plant, and equipment. It's much more harder to sell property, plant, and equipment than it is multiple securities to pull your cash out. So even though Apple has a current ratio that is very troubling, this wouldn't be the end of the world for me, specifically as an investor, because I know Apple is a well-established company. They have a very high net profit margin, correct? They're utilizing their assets pretty well to enable to kind of earn on net income. So this is not the end of the road for me, to be honest, right? And it did increase from 2022 to 2023, which is very impressive, correct? So that's something to kind of consider. Now to kind of look at the solvency ratios. So the solvency ratios kind of deals with their debt financing. So the first solvency ratio that I'm going to focus in on is going to be that of the debt to assets ratio, which is going to be essentially total liabilities divided by total assets. So I'm going to do this for 2023 and 2022. So to calculate the total 2023 debt to assets ratio, I'm going to go to total liabilities, which is 290,437 divided by total assets, which is 352,583. So the 2023 debt to asset ratio is 83%, or you can say 82.4%. For 2022, it is 302,083 divided by 352,755, which is 85.6%. So the debt to asset ratio essentially tells us that out of total assets, how much is financed through total liabilities. So essentially the higher the number is generally a bad thing. And that's because if you think about it, there's two ways a company could finance their operation: through equity financing, which is the issuance of common shares and preferred shares, or through the retained earnings, which is net income that is retained back into the business that's not paid out of net income, or debt financing. So with debt financing, interest expense is an obligation, meaning if in 1 year a company cannot pay off their interest obligation, the banks could call back the loans and potentially drive the company into bankruptcy. So that's why generally a lower debt to asset ratio is feasible or is desirable. So Apple did do a good job of reducing this from 85.6% to 82.4%. However, this is still fairly high. However, since Apple is such a well-established company, a high debt to asset ratio can be challenged through another ratio called the times interest earned ratio, which is going to be essentially going to be operating income divided by interest expense. So this ratio tells us essentially how much operating income the company has in comparison to this interest expense and how many times it could cover it in a given year. So to kind of locate these variables, we're going to go to the income statement, which is right over here, the consolidated statement of operations. And our operating income is given to us directly over here. So we're going to do this for 2023, 2022, 2021. So in 2023, our operating income is 114,301. And now we have to kind of look for our interest expense. So interest expense most likely will be part of other income / expense net. So what I'm going to do is I'm going to do a quick search find. So click on find and replace. Nope. Go over here. Click search find over here. So if it's a computer, I'm just doing Control F, correct? And then I'm going to look for interest expense. There you go. So a quick search find shows me that in other income / expense net, We have interest expense from every year of 3933 in 2023, 2931 in 2022, and 2645 in 2021. And remember, this is included in the notes of the financial statements. So we have the financial statements, then we have the notes. The notes just go into each account in more detail and kind of break it down for us. That's it. So the interest expense, I'm just going to type it out over here, just so I don't have to keep going back and forth. And interest expense is a negative number because remember, that's reducing our overall net income figure because interest expense is money that we're losing. Remember, an expense is a cost incurred, consumed, or used up in order to earn revenues. So 3933, 2931, 2645. Perfect. Now I'm going to scroll back up to the income statement. So here we go. Then I'm just going to run through the actual formula now. So operating income for 2023 is 114,301 divided by the 3933. 29.06 times, which is fairly high. Then we're going to do it for 2022, which is 119,437 divided by 2931. Then I'm going to do it for 2021, which is going to be 108,949 divided by 2645. So as you can see, Apple has a very high times interest earned ratio. So even though in 2023, Apple's operations are funded 82.4% through total liabilities, it has enough operating income to cover its interest expenses as they come due. Because Apple is such a well-established company that their operating income is much more higher than their interest expense. Even though this ratio higher the better, even though the ratio decreased significantly, I still won't attribute that to a red flag because overall, Apple still has enough operating income to cover its interest obligations. So this is how you would read company's financial statements. So overall for Apple, since they're a well-established company, I would definitely invest into Apple because overall their dividend payout ratio, even though it's lower than the industry average, it is still good in my eyes. Yes, operating activities from operating, so essentially activities from operations did decrease, right? However, it's still a fairly good number, and that decrease is obviously attributed to the decrease in sales. Even though sales did decrease, our profit margins and our gross profit margins are still very consistent. Correct. And then we're going to talk about return on assets, which is fairly consistent as well. The current ratio does raise red flags. However, the fact that the company has considerable marketable securities, that kind of eliminates that red flag for me. And then overall debt to asset ratio is very questionable. However, the company has enough operating income to cover its interest obligations on this debt as it comes due. So I wouldn't be too concerned about it. So this same type of analysis you can apply to other companies as well. And this is just kind of how you would approach this.